Should I buy stocks with a credit card? The dark truth. Every investor must balance risk versus reward, but attempting to buy stocks with a credit card can quickly turn the odds against you. If you have some disposable income right now, you may be considering putting those funds into the stock market to grow. However, using a credit card to do so could put you at risk for fraud, hurt your credit rating, and end up costing you more than you could earn in returns. Most reputable firms won't even allow it, and taking the risk could have unpleasant consequences. Do you think it's wise to buy a stock using a credit card? Let us know in the comments section below. For now, let's shift to matters of stock and credit cards. There are a few ways that you can use a credit card to buy stocks. However, it's not easy and may not be a good idea, even if you're up for jumping through a few hoops. The additional fees you'll pay could start you out in the red, and if you're being pressured to use a credit card, that's a warning sign that it's a scam. Most brokerage firms won't let you directly fund your account with a credit card to buy and sell stocks. Instead, you'll have to fund your account in other ways, like a bank transfer, check, or wire transfer. There are some creative ways to indirectly use a credit card to buy stock, but the downside can be tough to justify. Using a credit card could potentially affect your credit scores in several ways, regardless of what you purchase or why you initiate a balance transfer or cash advance. If you apply for a new credit card, the resulting hard inquiry may hurt your credit scores a little. The new account will also lower the average age of all your credit accounts, which could cause your scores to dip. Whether you use a new or existing card, your credit card's balance can have a significant impact on your scores. Your credit card utilization ratio is a comparison of your card's credit limits and balances as they appear in your credit reports. A higher utilization is worse for your scores. Therefore, if you have a high credit balance due to a big stock purchase, your credit scores could drop as a result. However, your score could also quickly recover if and when you pay down the balance. Using a credit card to buy stock generally isn't a good idea. Investing in stock requires taking on the risk of losing money. By buying stock with a credit card, you could wind up with a high-interest credit card balance and lose your investment. Additionally, using a credit card can be a bad idea because you may have to pay fees to the brokerage, an intermediary, or your credit card issuer to use your credit card. You might not earn rewards. If your credit card offers rewards, you generally won't get them for balance transfers. You also might not earn rewards when purchasing gift cards or for cash advances. You start with a loss. The goal of investing is to make money, but using a credit card can result in an immediate loss from the fees. As a result, you'll have to make money on the investment just to break even. There's additional pressure to make a quick return. If you're using a credit card with a promotional offer, you'll feel added pressure to make money before the promotional period ends and a higher interest rate kicks in. It could be a scam. The U.S. Securities and Exchange Commission have published several warnings about fraudsters who pressure people into making investments with a credit card. They may steal the money along with your card account information. In short, credit cards can offer rewards and purchase protections that make them a better option than debit cards in many cases, but buying stock isn't one of them. If you want to invest, there are plenty of options besides using funds borrowed from a credit card. Anything that doesn't charge you an interest rate is preferable, even if it means investing more slowly. When you invest in a stock, you're taking a calculated risk. If you're unable to afford the amount you invest today, chances are you'll rack up much more in high interest on your balance than you stand to gain with your stock investment. And if you lose money with your investment, you may face more money owed in credit card fees on the balance due to late or missed payments and take a credit score hit. Today, average credit card interest is above 16%, while average stock market returns vary but are generally considered around 7 to 10%, and that's for long-term, less volatile investments. Borrowing money to invest in the stock market can cost you more in interest than any returns you may see. If you want to start investing in stocks, only put in as much as you can afford today and assess all the risks beforehand. According to the Securities and Exchange Commission, most reputable firms don't allow the use of credit cards to invest. Sellers who pressure you into using credit cards are more likely to use your money for fraudulent scams. And anyone asking you to immediately invest large sums of money likely does not have your best interests in mind. If you choose to go ahead with using your credit card to invest, keep an eye on your credit account for any questionable transactions. If you notice anything suspicious, report it to your card issuer immediately. Buying stocks with your credit card is a risky business. But that doesn't mean you can't use it to help you get returns on the market. There are safer ways to do this which don't involve directly buying stocks. Instead, you can leverage your credit card to grow funds. When you don't have a lot of money to invest, you may want to look for a brokerage that lets you buy fractional shares. Rather than having to save up and buy an entire share of a company's stock, you can specify the exact amount of money you want to invest and buy a fraction of a share. If you want to borrow money to invest, the best option may be a margin account. These let you borrow money at a much lower rate than credit cards directly from the brokerage. However, there are many rules and regulations you'll want to learn about first, and it might not be a good idea for a new investor. Additionally, some brokerages offer cashback credit cards. You can use these rewards cards to deposit the cash back directly into your investment account. Ultimately, though, the need to borrow funds to invest might mean that you're not financially prepared to start investing. If money is tight, it might be better to reduce your expenses and set aside cash funds you can use to make investments. Even if you think you might have found a surefire investment strategy, be very cautious of making rash decisions when it comes to borrowing money for investments. An online brokerage account is the most convenient place to buy stocks, but it's far from your only option. If you see yourself as a hands-on investor who likes researching companies and learning about markets, an online brokerage account is a great place to get started buying stocks. Online brokerages offer taxable accounts and tax-advantaged accounts. If you want to buy stocks to fund your retirement, consider an individual retirement account, IRA, that offers you certain tax advantages, like tax-deferred growth of your investments and potential tax credits on your tax return. If you're investing for a day sooner than retirement, or you've already maxed out your retirement accounts, look to a taxable brokerage account. While they don't offer the tax advantages of IRAs, they also don't have any limitations on how much money you can deposit or when you can withdraw funds. Your online brokerage of choice might also ask you if you want to open a margin account. As we've mentioned, with a margin account, the brokerage lends you money to buy stock. This lets experienced investors buy more shares of stock with less of their own money in exchange for additional costs and much more risk. If you've already identified stocks you'd like to buy, you may consider a direct stock purchase plan. Not all publicly traded companies participate in direct stock purchase plans, but many of the most popular names do, and you don't need a brokerage account to buy stocks this way. You'll most likely be charged additional fees. With the ready availability of low and no-fee online brokerages, many direct purchase plans have fallen out of favor. However, they may allow investors to purchase a specific company's shares at a slight discount, which may help make up for the fees they charge. Carefully evaluate the benefits of investing using a direct stock purchase plan before you make your first purchase. Whichever strategy you choose, finding the stocks you want to buy can still be challenging. Stock screeners help you narrow down your list of potential stocks to buy and offer an endless range of filters to screen out all the companies that do not meet your parameters. Nearly all online brokerage accounts offer stock screeners, and there are more than a few free versions available online. With a stock screener, you can filter for small cap stocks or large cap stocks, or view a list of companies with declining share prices and stocks that are at all-time highs. They also generally let you search for stocks by industry or market sector. A company that pays dividends is often one with a degree of stability, especially if it's increased its payout consistently each year over decades. But watch out for companies that have very high yields, calculated by dividing a year's worth of dividends by the stock price. A spike in dividend yield can mean a company is getting desperate and trying to attract or keep investors with that income stream. High dividends could also indicate that a company isn't investing enough in itself. A company can temporarily or permanently cut its dividend to secure more liquidity during challenging economic times. This doesn't necessarily mean the company is in jeopardy, but rather that the business may require more cash to pay immediate expenses. Companies can cut dividends if they expect lower earnings or unexpected short-term expenditures, in which case they would retain the money that would have been distributed as dividends to address financial needs. But if a short-term problem becomes long-term, you may have to reevaluate your position. As you track your stocks along with the performance of those companies you invested in, be wary of cashing out too soon. The money you invest in individual stocks should be money you're comfortable having tied up for at least the next 5 years. To maximize your returns, your best bet is to hold on for the long term, especially during times of volatility. In fact, not giving your investments time to grow is one of the biggest investing mistakes experts say you should avoid. Investing is an important part of many people's financial plans. But before taking an enormous risk such as borrowing money to buy stock, make sure you have a solid foundation. For many, that means an established emergency fund, no high-interest debt, a good credit score, and investments set aside for retirement. That's all we've got today. What do you think of investment apps? Are they reliable? Let us know in the comment section below.